Good morning. This is Ron Brown. It is Good Friday morning at about 8:15 a.m. Central Time. I'm going to take a look at the markets through the lens of HGSI Investor, show you how I use my files, or some of my files. This will not be a lengthy report. I'm just going to try to give you some ideas. So this is my standard risk disclaimer. I'm not an investment advisor, of course. I'm a software consultant, and I show people how to use the software, and I also provide many scans and ideas using my Insider Club. So let's get started. I'm going to get this out of the way. I have my software open in front of me. This is kind of a mess right now, but it'll get straightened out. I am using the designer, the warehouse, and the ranking module, and a chart right now, and I'm currently in this folder in my market analysis user groups, the major markets plus. I'm clicking through to the warehouse, and in the warehouse I am using my top-down analysis view for major markets, end of day. And this provides 14 indexes. Now, I did remove the Amex index this morning. If you update your add-on file, you'll no longer find it. It just didn't, it doesn't fit in. It's full of ETFs and so on. It doesn't really give a true look at what's happening in the market. So what I have here is a sort on the percentage price change one day, and you can see what happened on Friday. The utility were up, nothing else was up. Let's go to the NASDAQ. It'll come up down here, and I'll zoom in on this a little bit, and you can see that the NASDAQ is struggling to get out of this area here. Very dangerous market, down, up, and down, and what looked like a promising day on Thursday was wiped out by Friday on lighter volume. The index did hold at the 61.8 retracement level. That is from this low to this high and then back again. But the more it struggles to try to gain some upside momentum, the harder it's going to be, because there's a lot of people who have bought, a lot of traders, investors who have bought, and every time they think they're going to make money, they get hammered again, and it gets very discouraging. So investors have a couple of options. They can just stay out of the market, or they can go where the strength is if they're long side only players. There aren't that many short side players, but those are really about your two options. Let's just take a quick look at a few things here. We're down 17.6 from the 52-week high, only up 6.3 from the 52-week low. The fan trend is down. I'll show you that in a minute. Volume was slightly less than normal. And you can see if I bring up my, let me do that again, alternate I keys. There we go. This information is the information that's in the chart. And if I look down here, you can see yesterday that the when I click on the correct data, that is, the advancing stocks were 1020, the decliners were 2273, so a little more than 2-to-1 negative, not overwhelmingly negative. The new highs are only 58 and the new lows are 131. So a very weak market. You can see the accumulation was in B for a long time, and then it went to C. This is not very responsive because it uses the Chaikin 21-day indicator as one of its primary inputs. Still, it's valuable to see where the index was on E distribution to D to C as it moved up. Let me put a crosshair on here. And then as it got up here, it went to B and then at A, and it looked good, and it kind of it stayed over there in the B accumulation, and then as the market started to drop, it took to this point to get down to C. So the way I look at it, it's just much better to look at the candles, support and resistance, and this is a factor up here, but you're going to gain a lot more knowledge by looking at the individual candles and what they tell you. Look at the open and the close, look at the gaps, and look at the struggle here. This is a painful market for a lot of people. I'm going to go to a different chart. I'm just going to go down to the next chart, and the Fibonacci will stay in place, but you can see the new highs versus the new lows. They're not extreme here, even though this market has been falling hard. Notice the difference here between the new highs and new lows. Compare that to back here or to here. So it's not extreme, and the volume has been falling off. The lack of volume indicates lack of interest or lack of commitment to the market. Compare that to this volume spike as money started to flow in. These volume bars were all above the moving average, and look where they are now. They're all below the moving average. So even though there has been selling, there hasn't been panic selling. If there were these, there would be big volume spikes here. So this tells me a lot of people are just waiting it out. I have friends who have money in IRAs, 401ks, and so on. They aren't even looking at their statements now. That's the kind of market that we're in. There's a lot of pain, but they're not selling, and they're just hoping for a turnaround. And that's not a good situation to be in. Let's look at one more. I'll look at chart number 3. This shows the advanced decline line in the NASDAQ, and you can see that it's clearly going down, but on lighter volume. It's just people are frozen. The average investor is anyway. What we need to see for this market to turn around, in my opinion, it's just based upon years of experiences, we need to see a selling climax where fear just takes over and people start dumping their stocks. And when that happens, then we have a really good chance for a strong rally. But there are so many cross currents in the market right now with what's going on in Ukraine, the war, inflation. It's just everything is coming together on the negative side. Throw COVID in. It's we're seeing a resurgence of COVID. Not nearly as bad as it was in the past, but still, all of these factors are negative. So you have the double whammy, or triple or quadruple whammy of let's just concentrate on the stock market going down, and then you're losing buying power with inflation. And the mood of people is very negative. So what can you control? Well, if you're a stock market trader, investor, you can control how much money you're losing by having a risk plan in place. And if a stock gets to a certain level, you just you take the loss, or the loss of the gains that you previously had, and you just get out. But the problem is that people will wait and wait and wait until they just can't take the pain anymore, and that's when they sell, and that's when the market generally turns around. Okay, enough said there. So let's just take a look at this and in the ranking module. Now I've set my ranking module at 26 weeks, and that's about the time the top was in. And let's see what happened. Now, people talk about the market as being all-inclusive, and it's the furthest thing from that. It's not all-inclusive. There are certain segments and groups that do well, while others are not doing well. Now, these are the major market indexes. Now, I have this folder called the, well, let's go down to it. I'm sorry, I need to get to my warehouse views. Okay, now it's top-down analysis, major markets, plus with ETFs. So I have a lot of ETFs in this folder. And what this does is it gives me a much better view of what's happening in the market. I'm not just using the major indexes. I'm bringing other ETFs into play, which give me a look at different market segments. Now, if I click through to the ranking module, this shows me that over those 21 weeks, the natural gas fund is up 53%, gasoline's up 51%, oil is up 47%, and so on down the list. Let's look at Bitcoin Investment Trust, down nearly 40%. IBD 50 is down 28%. Treasury bonds are down 18.6. The SOX is down, the SOX is down 22.59%. So, looking at this, it's obvious to see that the tech stocks are not the place to be. Here's the NASDAQ down 17%. So often when we think about markets, we think about the NASDAQ and the tech stocks. It's just not true, because there are all kinds of options, and these are all playable or buyable by the public, the general public. And we can buy any of these or sell them. Let's just take a look at another. I'm going to move down to this percentage return for 12 months. Since this is a weekend, there is no intraday data, but you can see what has happened with these ETFs and the major markets. Over a 12-month period, this natural gas fund is up 165%. Oil is up 85, 83 on gasoline, and so on. So if you pay attention to rotation in the market, and it's easy to see in HGSI, there are always opportunities on the long side and the short side. I'm going to bring up that natural gas fund, and I'm going to change charts. I'm going to get out of my market charts and go down to my number 1A chart, which has the fan in it, the 200, the 100, the 50, the 18. This is the 6, and this is the 3. And you can see, looking at this chart, the natural gas chart, that this fan formed. Looks like back in this area where the 200, the 100, the 50, and the 18 were all positive at that point. Somewhere right in here, and it has stayed pretty much intact, maybe a little dip down right there. But from this area here for sure, as this ETF moved higher. When you see a fan expanding like this, it indicates that there is strong investor and institutional interest as these lines move apart from one another, and you can see it down here in the histogram. This is a 3 versus a 6. This is a 6 versus the 18, and the 18 versus the 50. These are all labeled over here. Let's take a look at some of the ETF. Here's a test. Here's a confirmation of that test. Another test. This is strength returning after a downtrend, a longer-term downtrend, and now it's trending up. This is a no supply, but the 3 has been above the 6 from this point right here, which means that the short term has remained up. Now the UNG, this is all the result, I assume, of what's happening in Europe and Ukraine, shutting off the natural gas supply from Russia, and it has to come from somewhere, and the U.S. is going to supply or trying to supply natural gas to the European countries. So what happens? It goes up. Because during the winter months, let's go back here, this is January, some of the coldest weather in the country. Look, it was down here around $13. Where is it now? It's clear up here over $25.50. My point is that there are always opportunities in the market when you look at a market from different perspectives. Let's take a look at oil. Not nearly as pretty a chart, is it? And it's been very volatile, and I can see why this is a very difficult market to trade. It's really emotional, of course. Natural gas, as we saw, was much cleaner. Let's look at UGA. This is gasoline, a lot like oil, very volatile. You have to have a strong stomach to trade this. Let me bring that back up. You can see the fan is in place, but if you use the 3-6 crossovers, it helps keep you on the correct side of the market. This was going down at this point. You can see it down here in the histogram, and then it reversed right here. Much more short-term trading, though. Once again, I'm going to go back up to natural gas. Look how much smoother it is. Look how much longer the 3 stayed above the 6. You're looking at it in this window right here. It's what's called the micro trend. Now, let's go to the other extreme. Let's look at the SOX. As you can see, it's all over the place. Let's take a little longer term look at it here. If you just look down here at the histogram, the 3-6 micro trend, you can see how volatile it is. But there are good signals here. Here's a long signal, the 3 crossing the 6. You can see it starting to fade right here on this black candle. And then the 3 went down through the 6 here for a short. This is confirmed with the short-term trend. The histogram turning negative right here. It's a little late, but here is the downturn. And this, the 18 versus the 50, has been negative all this time, which is a pretty good indication that there's absolutely no trend to this ETF, or to the index, I'm sorry, the Philadelphia SOX. Now this doesn't have volume, so there's nothing down here in the VPAR. Let's go back to the warehouse, IBD, fund, Bitcoin. Let's look at the NASDAQ composite with this one more time. And here's the 3 crossing the 6, which is a good buy here. Where did it turn negative? Started turning negative right here at the top of this run, and it went down. Notice the volume point of control based upon 10 days went negative also, and that was a good signal right there to get out of the market and really stay out of it for now, especially if you're in the techs. But on the other hand, like I've been talking about, there are always opportunities on the long side if you're willing to play ETFs. What you want to do is look for charts that are expanding nicely. What is this? This is Gold Miners ETF. It's a little choppy in here. Yeah, it's choppy in here, but the fan is in place, and once again, that shows strong buying interest. A lot of these VPA flags are really good. You should pay attention to them also. These are 1-day signals, 1 or 2-day signals for the most part, but they generally give us a good idea of what an ETF or a market's doing. And then you combine it down here with the histograms. You can see the chop in here, but even though there was chop, the trend remained in place, and there's a series of higher lows and higher highs, which indicate a trending market, which indicates a trending market. Now, what I want to do is I'm going to do one more thing, and then I'm going to end this. I'm just going to go down to my industries. I'll click through to the warehouse views, and I'll just go down here to my top-down scorecard views for HGSI index analysis. You can see the percentage change here. There's only a couple of stocks in here, so you have to be careful about that. Some of these are not very well populated, but there have been all kinds of opportunities on the long side. Marine shipping has been up and down. I did a short video yesterday showing that There was a pullback here to the 50, and these started going up again. It showed up very well in those instant smart groups that I'm creating now, but there just has been a lot of strength, and if you go down to the bottom, there's been a lot of weakness. I'm going to flip back up to the percentage return, 12 months, up here under my top-down process views for market analysis, and this just shows you that there has been tremendous strength if you're in the correct groups. And these rotate in and out daily. No, I shouldn't say daily, because once these trends start, they have a tendency to stick around a while. Let's just take a look here at steel's been actually exploration and production has been one of the really good groups, and you can see that the fan is in place, and there have been a few dips here, but very short-term dips, pulled back between the 18 and the 50, took off again, and for the most part stayed above the 18. I mean, you think, well, yeah, that's great, but we're looking now at what's happening now, what's happened in the past. Well, I'm going to show you something. I'm going to go to my non-index groups, and I have market leaders here, and I started collecting these in January. What I'm going to do is I'm going to click up here, and I'm going to check the children, and this checks all of these months and the stocks within here. Let's see how many of them are in the exploration and production. It'll bring up individual stocks, but I just want to point out that here's one right here. This has appeared 60 times since I started tracking these, and I started tracking them in mid-January, so it started appearing here on the 19th of January, 2022-01-19, and it appeared multiple times. That's CNQ. Let's look down here. Here's another one, Pioneer, midstream oil and gas, same sector, integrated oils. You can see that these all started appearing back in July, and I'm sure they appeared before that, before I started tracking these. Let's just take a look at the top stock and see what it looks like today. CNQ. Okay, here's CNQ. This is the 19th. So where it started appearing, and I wasn't tracking this leading group back in here, but I'm sure it would have appeared long before that, and you can see the run that it's made. So these stocks come up, and once a trend begins, it tends to persist. Let's do one more thing. I'm not so sure that this will show us anything, but I'm going to clear these, and I'm going to go up to my top 50 group inclusion report, and let's start with December. I'm going to check the children, which checks all of the stocks below, and I'm going to check the shorts also. I don't want to take the time to separate them out. Okay, here's Devon. This one started appearing on the February 2nd, I'm sorry, the 3rd of February. Here's Chevron on the 1st. Let's look at Devon. This is the top 50 group inclusion report. I'll just bring up a chart and then put DVN in here. Okay, what do we have here? This is January. Started appearing here in the top 50. It's not quite as pretty a chart. I mean, it did move up and then we had a sharp pullback here. But even during this pullback, the fan did remain intact, because here's the 18. It didn't come down through the 50. So very strong stock over a long period. Now when I zoom out, you can see that it really started its move back here in September, and the fan remained intact the whole time. How do I know? I just looked down here at the histogram. You can see that it went positive. The 50, the 18 went above the 50 here, and it never did come down under the 50. So that remains, or the fan did remain intact. If the 18 comes down through the 50, the fan is temporarily broken. So I'm going to sum it up. There are always opportunities in the market. HGSI is the absolute best program out there to stay on top of this. We can look at the warehouse views, ranking views, the scans. It's the way to go, in my opinion. You don't need to spend a bunch of money on other software programs that cost you a lot of money, and they're certainly not going to make you any more money. But anyway, that's just my opinion. Others would disagree with me, of course. But I use HGSI, EdgeRater, Sum, and Thinkorswim. That's it. Thanks for listening. Have a good Easter weekend.